I lend you the gold, but it's a paper transaction. In other words, I give you title to the gold. I now take a first perfected security interest in it. I charge you some money, I charge you rent in effect, so getting a little bit of income on it. But the gold doesn't actually go anywhere.
Yeah, that's one element of the gold lending market, but another element is that where it's actually loaned, physical bars are brought into the market and then they're sold, refabricated into other things. As long as central banks report gold and gold receivables, and even the U.S. government now is talking about gold swaps on its official statements,
right,
that we just don't know how much gold is really there. But I guess coming back to the main point is that even talking about gold, are you seeing some kind of euro gold link at some future date to try to establish confidence in the euro?
Absolutely. I mean, I've said all along that the first major currency to go to gold backing will be the only currency that anybody wants. You know, if the euro will move to gold, it's the only question in my mind is how. Will it be thoughtful? Will it be researched? Will it be studied? Will it be bipartisan in the case of the United States, the way we got to the euro, or will it be chaotic and messy and sloppy and emergency decrees because people have lost faith in the paper money? To me, either one of those outcomes is possible, and maybe the chaotic outcome is even slightly more likely than not. But either way, you'll end up at gold because the paper system is clearly not sustainable. You're not going to be able to, there's no feasible combination of growth and taxes that's going to pay off the debt. Can't be done. Because the minute you start to raise taxes more to get revenue, you hurt growth. If you don't raise taxes, you've got these deficits, but at the same time, what are the drivers of growth? The consumers are indebted. Who's going to invest if the consumer's not there to buy the output? Government spending has hit the wall. As we've seen in the deficit ceiling debate in the United States, there's no appetite for more government spending. There's no appetite for more quantitative easing. They might do it, but the political bar there is extremely high. So what are you left with? The only thing you're left with is net exports. Mm-hmm. How do you generate net exports? You trash your currency. Mm-hmm. Well, how long can you trash your currency before people lose confidence in it completely? I mean, we're in a full-scale currency war. That's what's going on right now. I talked to people in Zurich this morning, and they said, you know, how long do you think the appreciation of the Swiss franc can go on? I said, it's going to go on indefinitely because there's nothing to change the dynamic. The U.S. doesn't want to take the dollar down 10% or 20%. They want to take it down 40% or 50%. That's what it'll take to get Americans to stay home, make it too expensive to go to Europe, increase sales of Boeing aircraft and IBM services, et cetera.
But the dollar is the world's reserve currency.
Right.
You know, the U.S. government has a tacit responsibility to the rest of the world to maintain a currency that preserves its purchasing power. So to incur that kind of a drop in the purchasing power of the dollar from inflation, whatever means they use, you're basically having a ripple effect throughout the globe.
I agree with that completely. But I should be clear, James. I'm not advocating these policies. I'm just telling you this
That's
is
what the United States government
play
out. Yeah.
Yeah, I'm not a politician. I'm an analyst. So my job is to sort of look at the dynamics, look at the indications and warnings, and kind of call it like I see it. So I'm actually an advocate of a strong dollar. I would say that if we had a strong dollar policy and better economic policies and stronger growth, we probably would not have to go back to the gold standard. But because we're trying to trash the currency and because we're hurting growth, at some point people will lose confidence and you'll be forced to do it one way or the other. So it's at least it's a good thing that we have the gold.
Just get back to the euro one more thing before we go into other areas. You drew the comparison between the euro and the dollar, the European Union and the United States.
Right.
One of the obvious differences, of course, is the U.S. has a common heritage, common language, et cetera, and a constitutional framework in which states have certain rights and the federal government has certain rights. Right. You're lacking some of those elements in the European Union. Isn't that going to be an impediment to actually coming about to any kind of a position where the euro survives? You know, we have a lot of different sovereigns and a lot of different politicians in different parts of the world.
Well, you're lacking some of the elements, but not all of them. It is true that Europe is more diverse culturally than the United States, but although that's probably changing. I mean, look at the Hispanic influence in the United States and other immigrant groups from time to time. So the U.S. has got its own kind of diversity, but you're right, it doesn't have the same political diversity of Europe. But that's precisely the point. It was the political and cultural diversity of Europe that gave rise to war after war after war, century after century, that they want to overcome. So how do you overcome that? Well, you do it through institutions. And in Brussels and in the European Union and the European Parliament, they have built these institutions. Now, sort of, it's sort of a sovereignty balance. Here's national sovereignty and here's European sovereignty. What's been going on over the last 20 years and is accelerating is that national sovereignty is declining and European sovereignty is going up. And we saw that with this new ESFS, where Greece and Italy and Ireland and Spain and Portugal have given up some of their fiscal sovereignty to this new fund, which is run by Germany, but it's a European institution. And my view is that I think that in Brussels, they're not entirely unhappy with the euro sovereign debt crisis, because the debt crisis, remember Rahm Emanuel, President Obama's first chief of staff, said never let a good crisis go to waste. I think we're seeing something similar in Europe. I think Brussels is saying, hey, we've got a good euro sovereign debt crisis here. What an opportunity to expand our euro sovereignty.
Well, maybe Brussels is happy, but what about the French farmer or the Greek middle class, or the German taxpayer who's underwriting a lot of this stuff?
Well,
how far can they go before they get a popular revolt?
Well, it's interesting. You got three different cases. I think the ones that are closest to revolt are probably the Greek middle class, because they're going to suffer the austerity, the cuts in benefits, the higher taxes, the more rigorous tax collection, the decline in exports, from a strong euro. They're going to suffer the most. The French farmer is very heavily subsidized under the common agricultural program. So even with Europe, even with expanded European sovereignty, I don't see anybody messing with the farmers. And the French farmer is the classic case, but you got Spanish farmers and Netherlands farmers and German farmers, et cetera. So that's sort of, we say in the United States, Social Security and Medicare are the untouchable third rails of politics. Well, in Europe, agricultural policy is the untouchable third rail. Now you go to Germany, they're actually doing fine. I mean, as I say, they're an export powerhouse, even in a strong currency environment. So the problem with the currency wars, of course, is that not everyone can devaluate at the same time. You have to take turns. This happened in the 20s and 30s. France devalued in 1924. England devalued in 1931. The United States devalued in 1933. And then it was France's turn again in 1936. Mm-hmm. So you had these sequential, what are called beggar thy neighbor devaluations. Now the same thing is going on today. The US is trying to devalue. So who's losing the currency wars? Well, the euro's been fairly strong, to a lot of people's surprise. Brazilian real, we all know what's going on there. That's gone sky high relative to the dollar. Well, the Brazilians aren't going to stand for it. Oh, the Swiss franc is the other one. Well, at some point, the Brazilians and the Swiss are going to cry foul and do something. They're going to put on capital controls, or say you can no longer have 30-day deposits. They have to be
negative interest rates, like the Swiss did back in the 70s.
Negative interest rates, or maybe just extend the maturity. Say, hey, you want to make a Swiss franc bet? Fine. There's no more 30-day bets. It's got to be a 1-year bet or a 2-year bet. Mm-hmm. But some kind of close the capital account in some way. If they don't do that, what's going to happen to the Swiss economy? Tourism's going to dry up. Exports are going to dry up. And then think of the Swiss multinationals like Nestle, where most of their money comes from overseas. Well, if you have a strong Swiss franc, those overseas earnings are going to be worth less. Mm-hmm. So when they issue their financial statements in Swiss francs, they're going to suffer losses. Mm-hmm. So you're going to hurt your stock market, tourism, and exports all at the same time. They're not going to put up with it. But then if they take steps to weaken the franc, what does that do to the dollar? You're back to this zero-sum game.
But let's step back a little bit from the currency side and look more at the big picture in terms of what's happening. And I want to bring up one of my favorite quotes from Margaret Thatcher. She said, the problem with socialism is you eventually run out of other people's money.
Right.
Isn't that really what's happening worldwide, and that regardless what they do with the currencies, that something fundamental has to shift and change here?
Yeah, I think it's already happened. I think the world is broke. I think if you did a hypothetical consolidated financial statement of every financial institution in the world, it would have a negative net worth. Now, there are some pockets of real money. Some of the sovereign wealth funds, some of the endowments, they're kind of long only. They've got these long-term contingent obligations to their beneficiaries or their citizens, but particularly in the case of citizens, those are very hard to define. And if they're well managed, so they sort of look like pockets of capital, but they're few and far between. The banking system and the national balance sheets, again, on a mark-to-market basis, I think there's no capital left in the world. So I think Margaret Thatcher was not just correct, she was prophetic, and we've already reached that point. So then the question is, where do we go from here? Well, for a while, it's sort of, my favorite metaphor is the old, Roadrunner cartoon where the Roadrunner runs out over the cliff, he's in midair, or sorry, the coyote runs out over the cliff. He's in midair and he doesn't realize it right away, and he looks down and crashes.
Are we over the cliff now?
I think we are over the cliff, but we're still running.
Believe we're still running.
In midair. Believe we're still running and haven't looked down yet. I think that's where we are.
When are we going to start looking down? Are we pretty close?
We're very close. I think this deficit debate, debt ceiling debate that we just went through in the United States was at least a glance in that direction. Because it says, well, we can't just keep spending, and we can't spend our way out of a situation of indebtedness. Now, a lot of people disagree with that. You know, you've got Nobel Prize winner Paul Krugman says our biggest mistake was we should have spent more, and I hear Larry Summers saying the same thing. I hear the president saying the same thing. So there are a lot of people who think that these Keynesian remedies just haven't been tried hard enough, and we ought to double down. By the way, I think that's what the 2012 election in the United States will be all about. It's going to be these two competing philosophies. One is, you know, if we just spend a little more and increase aggregate demand and, you know, government expenditure multiplier, what gets to self-sustaining growth. And the other side saying, are you crazy? We're over indebted. We need to clean up our balance sheet, cut spending, save more, invest more, you know, cut taxes, improve productivity. This is the debate for 2012.
But, you know, it's clear that there's no political will to get off this road that the U.S. government is on. I mean, they're talking about cutting from future spending. They're not actually really talking about cutting the deficit. Why should we believe that they're going to solve that problem in 2012? Because, you know, I'm the view that the government is over-leveraged.
Right.
You just look at it on a cash flow statement. They've got so much in promises and commitments, I don't see how they could ever possibly fulfill them.
Right, well, I'm not sure we should believe them. This is why I say going back to the international monetary system and the role of gold in these four scenarios of multiple reserve currencies, SDRs, gold, and chaos, I'm betting on chaos. I don't want that. I don't favor that. I don't think it's necessary. I think there are policies you could pursue to pull back from the brink and avoid that, but I agree the political will is lacking. The political will is there in some people. It's certainly there in the Tea Party. It's there in some more thoughtful conservatives. Alan Simpson, Erskine Bowles are not exactly, you know, Tea Party you know, tub thumpers, so to speak, but they've come out in the same place.
But was the debt limit increase a victory or a defeat for the Tea Party? You know, you can look at it both ways.
Well,